Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Today, we have part two of our two-part series on the Loan Officer Roundtable for the first quarter of 2021. This is a great and also entertaining discussion about what's going on and what's working and what's not working in multifamily finance and investing in multifamily properties and syndication and things that you need to know about if you're thinking about becoming a syndicator in apartments. So without further ado, let's jump in and finish the conversation, beginning with Dave Walls. Dave, let's start talking about financing.
Well, Paul and everyone, a happy new year. Well, first of all, probably one of the first things is really echoing what James and John and Ricardo had talked about regarding stricter underwriting, particularly from the agencies. We're seeing them focus a lot more on occupancy, bad debt, and also lease audits. I know Ricardo talked about a lot of things regarding the auditing from the agencies, particularly during the underwriting, and also them requesting financials and everything right up to the last minute, and even projected rents into, say, January this year. And I've got a couple of deals at the moment where they have asked for up to 50% of the leases to audit. And not only are they auditing the leases, they're also auditing the backgrounds of the tenants for employment and kind of why they're in the property. So it's definitely getting a lot stricter, and it's obviously it's due to the COVID issue we have right now, the pandemic. So that's what I'm seeing a lot. And so as a warning to all, sellers and buyers is to make sure that all that stuff's in order. If you're buying a property where the leases aren't recorded properly, or they're not filed properly, there's not a really, if you're buying a property which is sort of a bit of a mum and pop property, you better make sure that all the leases are in order, because, chances are if you're doing an agency loan on that deal, they are going to audit them, and they may audit, as I said, 20, 30, even up to 50% if they think there might be an issue with the property. So I won't talk too much more about that. I know Ricardo and John covered that a lot, but that's one of the big things I'm seeing. One of the other big issues is insurance, and I'm sure Paul may talk about this a bit later as well, but you've got to be very careful. When you're underwriting a deal, you need to make sure you have your insurance. I'd start getting quotes even before it goes under contract, just tell way in advance. Make sure you get a good handle on the insurance, because we're seeing deals where the insurance has been waffling on right up until a week before loan commitment. And, I've seen cases where it's almost doubled. And of course, we know what happens when we see insurance doubling, it affects the NOI, and you'll get a cut in loan proceeds as a result. So very important to make sure you're on board with the insurance, particularly in Texas. Texas is becoming more difficult to insure in, and so you've got to be on top of that. So I can't stress that enough. Another comment I'd like to make is, as we go into 2021, obviously we still have the pandemic and hopefully we're going to see the backside of that this year. But with the 10-year Treasury, the change of government going, I think you need to be a lot more conservative with your underwriting. I think buyers need to stress the deal. You do have to be very careful on analyzing how long you're going to own the property for, and your exit. You just can't, we've been spoiled with low rates. We may see that change this year. So once again, I think you can't have a deal that's too thin now. You're not going to be able to get away with it like you did in the previous years, where you could get out of the deal with capital gain, with the cap rate compressing while you own the property. So you've got to be a lot more careful on your underwriting. And the other thing which I've noticed too, and it may change a bit this year, is it's still very much a seller's market. And so, sellers are sort of still wanting their asking price. They're still wanting a bit of hard money, shorter feasibility periods. So once again, buyers need to be aware of that and build that into their strategy for buying a property. So even though I thought that would soften up a lot last year and going into this year, I'm still seeing that. So time will tell. once the dust settles on COVID and the new government and its policies going forward, I think we may see a change there. But I can't stress enough, being diligent with your underwriting going forward on deals. And you can't get away with a thin deal. I don't think you're about to get away with a thin deal going forward, especially with an exit, with higher interest rates possibly, going to be hitting us this year. But I will say that you got to remember that people have to live somewhere. There's always going to be a market for multifamily. You've just got to be more careful, but it's always going to be there, and it's always going to be a great space to invest in.
Hey, Dave, can you talk about, I know some of the transactions you recently closed were in maybe some secondary, tertiary markets. Maybe talk about how some of those got done.
Yes, well, a couple of deals. I had a quite a difficult deal down in southern Texas. It was a 100-unit deal that was built back in the 40s, and the owners were out of country, and they completely dropped the ball. It was a sad example of how a property can spiral down with out of country ownership, let alone out of state. And also they had some very poor local management companies trying to kind of band-aid the property along. So my clients who were experienced found this property. When they bought the property, it was at 11% occupancy, 11%. So it was only a couple of plywood windows short of a hard money loan, as they say. So this was, there was a ton of deferred maintenance. So the challenge was finding a lender. But I think through our relationships with banks, we found a great bank that did a conventional loan on this, a conventional loan. They did a 75% loan to cost. We had nearly $2 million worth of rehab, 25-year AM. We got 24 months of interest only, a 4.5% fixed rate for 5 years, and no prepayment penalty. So I thought that was a fantastic win for a property that really,
it's a fantastic win.
Be heading down the hard money market. So that was I think a very good example of a great team effort by all players involved there. Another deal which started off quite well. It was a deal in Central Texas, a 55-unit deal. It started off okay, but then through the underwriting, we had issues with a sudden increase in vacancies due to COVID, and also the moratorium on evictions. So as a result, we saw our potential loan proceeds drop by nearly $500,000. So it wasn't looking good at one stage, but once again, we got through it through a teamwork effort with the lender and the seller and the buyer. We managed to get back to original proceeds again on this deal, and that was through a great story and summary from the sellers and the buyers on how they were going to address the problem with the increased vacancies, helping out the tenants. So we put together a whole dossier of a whole summary of how this is going to be mitigated, and it was a pretty Mac loan. So once again, we potentially could have been down nearly $500,000 in loan proceeds it cost us probably about another 14 days to extend the transaction, but we got back to original loan proceeds and original loan terms. So it was our relationship with the lender and a great team effort again. And I don't think this could have got done without those factors involved. Anyway, so that's kind of a quick overview. Does anyone have anything to add to that?
Hey, Dave, on a deal like that, so I've had some similar type of deals here recently with, you go into a deal, you see a drop in proceeds and you've got to deal with a potential loan cut. What are you seeing in your markets around hard money and maybe buyers being a little more cautious going into these deals where, pre-COVID, it was a challenge, but now with COVID, I've seen a little bit, buyers coming in more conservative. Are you seeing that as well within your markets? And how are you guiding your clients around the hard money, going hard on the deal with money up front?
I don't condone hard money at the beginning of any deal. I understand that even in the market today, which is still surprisingly strong from the seller's point of view, and prices are still up there, I know that there is the need sometimes for a buyer to offer hard money to make the deal work so he can win the contract. I get that. I don't condone hard money, but obviously it's unavoidable. Sometimes if you want to win a deal, you may have to go hard. So I think the secret is at the beginning, you've got to do your due diligence. I mean, if you're going to be going hard, try and get into the property. Try and find out as much as you can before you actually do have to go hard. So it's going to be a matter of writing up the contract, working with the realtor, and putting together a contract which is going to be safe for you, and also the feasibility periods. We used to have, for due diligence, it used to be typical to have 30 days to go through the property and look at all the physical condition, lease audit. I've seen it as low as 15 days. And so, there's a lot of pressure on. I think it will change. I think we're going to see a turning around this year. But up to date, it's still very much a case where, the buyer just has to be a lot more diligent, and they're going to have shorter periods of time. And, you just got to be so careful. If you do go with hard money, you've got to be very careful and have as much knowledge of what you're getting into before you do that. And the other thing is, if you do go hard, make sure that money is held in escrow by a third party. Don't have it where that hard money goes directly as a check to to the seller, because it's going to be very hard to get that back if you want to try and wriggle out of a situation through the contract.
Very interesting. Good job in closing those transactions there, Dave. Julie Peterson with Old Capital. She does transactions throughout the nation and sometimes in small and tertiary markets. Just recently closed a deal in Arkansas. Is that right, Julie?
That's correct. Yes.
Let me get your perspective of what you're seeing out there, and maybe talk a little bit about a challenging transaction or two and how you overcome it.
Well, I would tell you that, I work with a lot of new folks that don't have a lot of experience. So we're putting together groups, whether it's sponsorships or, people that can help raise capital for these people. And we're trying to put them together. These guys are looking in anywhere that they possibly can. So we've had a lot of tertiary markets, a lot of quoting. I did do a deal in Dallas area on an assumption. And I've quoted quite a few of opportunities where, can we help out with the assumption? And I was working with a group for over a year. I think we underwrote 250. Honestly, we were constantly underwriting, and these guys found an assumption. And so the question was, well, do we really need Old Capital help out on the assumption? And being that these guys had never been into their own transaction, we really encouraged them to let us help them. And when we finished the transaction, every one of them, even a couple that had done transactions with us in the past as a sponsor, really were happy that we were holding the hands of these new sponsors to really give them a sense of security and working on their behalf. So that turned out really, really well. Their first transaction, over $9 million deal. And in that case, on an assumption, they just could not walk away from this because they were purchasing a property that everybody else was at $130,000 a door, and they were about $40,000 less on this assumption. So it was an incredible opportunity for these guys to get in to multifamily. So we are very proud of that transaction. Also, in these tertiary markets, we talked about having to prove up and figure out how are these transactions, how are these opportunities working. And I'll tell you, I was in a deal on a 32-unit building in 4 days. This was a maturity date expiration on a bridge loan. And 4 days before the transaction was to close, and obviously to get out of this bridge loan that they had originally been in, 4 days, the evicted person who they actually at this point needed them to stay, they ended up leaving, which put their occupancy below 90. And so we were scrambling because we're closing in 4 days. And so we had to place somebody in that unit quickly. And we were able to figure out that somebody moved in that day, and we were able to close on a Friday, last day of the month, the maturity date. It was really a challenging transaction.
Let me make sure I understand it correctly, because in these smaller deals, when you have 30 doors versus 300 doors, one person who gets evicted or one person who leaves, that when we originally had done the underwriting of the deal, it made it 91 or 92% occupied. Again, 30 doors. But if you have like one or two people that move out, that can bring it below the 90% to maybe 85 or 86%. And now Fannie or Freddie take a look at it and said, well, that's not good. And we have declining collections and declining occupancy of the property. And so what you're telling me is that, this one person was evicted, but because they had to be evicted for down payment, but that was
we didn't want them to move.
Yeah. So you had to talk with the property management company, and at the last couple of days before the closing, you had to give them not only the buyer the news that you could need to find another person to replace that person and show us a brand new rent roll with that new person added, but you had to talk to the management company who actually had to do the work in that area to find the right tenant, not just to find somebody who could breathe on the mirror, but actually find somebody that actually could qualify, because that's what the lender's looking for. Did you just find somebody to place in there off the street, or did you really find a real person? So the smaller deals that does happen, that is a concern. Make sure, just like what Dave was saying, that the seller on these deals, again, this was just a refinance that had to be done, but on acquisition deals, especially these days, make sure the seller and the seller's team is motivated to keep their occupancy as high as possible going into the underwriting of these deals, because we don't just underwrite it, 60 days before we close. We underwrite it 4 days, 3 days before we close. And if that has a material change in the deal, it will screw up the transaction and you'll get less loan dollars, and then you'll have to go out raise more money at the very end. Any other challenging transactions at all?
I would only say that, and I would echo what's been said here on the Freddie. This was typically a place where you would go if you could put it together. If you didn't have a lot of experience, you live close by. That has kind of caused some sense of a pause. Freddie's asking for 2 years of experience, and I have been in transactions where we've had to bolt on another sponsor to make sure it was 2 years. Someone was bringing 1.5 and thought it would be fine. And that was in the middle of the transaction. They had it underwritten. And then Freddie came and said in October, sorry, we need 2 years. And then we had to find another sponsor to help close that deal. So keeping in mind, when you guys are putting these deals together, really look at the experience. It is critical right now. And I suspect that that's going to continue to be something that we're going to need to keep our eyes on as we move forward.
Yeah, Dave and Ricardo, I'll probably also mentioned insurance. Tell me a little bit about when you underwrite property insurance to these deals.
Well, I would say that, you want to have it underwritten where you're underwriting it yourself. Make sure that you're getting a quote from an insurance broker. Now, as we go through these transactions, we get to find out, if there's any loss runs with the property that you perhaps didn't know about. And that's going to very much impact the property's insurance policy. So while our underwriting from our lenders is potentially as low as they're going to offer, I would also encourage you to look at the area. If we're in an area like Texas where we get some hailstorms, that we're really underwriting adequately. And that had happened to me on a transaction. And I know, Paul, you had something that was critically impacted. Mine was not as much as yours, but I know that we try not to retrade these deals, because that's really, when you come to Old Capital, we really want to give you a real clear sense of what it's going to cost and what the loan dollars are going to be. And so we work really, really hard to provide accurate information and feedback so we don't have to retrade you. But these can impact you, as David said, and Ricardo, to just be aware.
Yeah. So my 2 cents, and then we'll kind of call it a day here. We'll get final closing comments from James. He's always an interesting plethora of underwriting guidelines and understanding to help you do your transaction. But transaction we just closed last week, and this was before the end of the month here, a couple of days before. We still hadn't had a real insurance quote on the property. And then this was a acquisition of a large property in the Dallas-Fort Worth area. Without naming names, the group had put a large amount of money into the title company that actually was passed to the seller. So they were going forward regardless of whatever the heck was going to go on. But when they underwrote the deal, they underwrote it at say $350, $400 a door in insurance. And that's kind of like the industry norm about where insurance should be. Maybe it's a little bit lower in some places, a little bit higher in other places, but in Texas, it's been about $300, $350 a door. And then when we underwrote the deal, we didn't look at their underwriting so much on that one line item, but we added up, I think, about $550, $600 a door in insurance. And so then we were asking them, and 3 weeks later, they came up with their insurance policy premium quote. And it wasn't, say, $36,000 for the annual policy, and it wasn't the $56,000 that we were saying. It was $101,000 for the insurance on this property. So what that did is that that made that one line item spike up tremendously, and then we had to underwrite that deal, and that caused the insurance cost being so high, it cut the loan dollars down by $1.5 million. So that one item changed the whole dynamics of the transaction. And so they had to do it. That was the best insurance that they could find the property. We were going to require insurance. And so the kind of the behind the scenes deal was, it wasn't that they were that far off, but before they found out that there was two items for insurance that were had to be taken care of by the insurance company. One was unfortunately a drowning on the property that the landlord had to pay. And the second, there was a shooting on the property. Again, we don't do properties in bad areas, but this happened to have a shooting, and the landlord got pulled in. His insurance company got pulled in, and that was an open line item. And because of that one thing, and those two things that were for the last 5 years, the insurance companies that they brought it to said, we're not going to do it, but if you want us to do it, it's going to be $101,000. And look at the impact that it had. John, have you seen that at all with some of your transactions with insurance and, flood insurance coming up or fire insurance and things like that?
Yeah, I mean, absolutely. I think insurance premiums across the country are on the rise. And that's one factor, is just insurance premiums are increasing. But if there's been a loss in the property in the last 2, 3, 4 years, then that can have a real impact. So something to watch out for if you're looking at your underwriting going in.
James, finish us off, please.
All right. So insurance is the one thing that they underwrite to the exact number. The same way that your management fee is underwritten to your management fee percentage, they're going to underwrite your insurance to the exact percentage. So I would be overly conservative on that number. While you guys were talking, I pulled up the reviews from the Old Capital podcast, and I just had to read some of these. 5 stars, Chris from Plano. How can this be free?
Do we start charging, James? Is that part?
Best world-class information, real-world information on apartment investing. Every episode is packed with insights. And this last one, 5 stars. Unbelievable. The smartest guys on the planet. Please just keep feeding me. So if you have made it this far in this podcast, we love you. We appreciate you. We are at 478 ratings. 4.9 on iTunes. Get us the 500. So go on, give us a 5-star rating. We'd appreciate it. And that is it from my end, Paul.
All right. Thank you to the Old Capital team. We've gone into extra innings today. So hopefully maybe we'll break this up into 2 parts. We do certainly appreciate all the hard work you guys did in 2020 and look forward to 2021. Hopefully things will change and we'll go back to having in-person meetings and in-person speaker series and get kind of a little bit farther away from Zoom meetings and be able to walk properties with everybody in the buying group. So again, we do appreciate everybody listening in. Just like James said, go back to iTunes, leave us a 5-star rating if you think we bring value to the conversation about multifamily ownership and finance. Thanks, team. And thank you for listening. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.